There are three stages in investing. The first one is when you learn to buy. Second one is when you learn to sell. And the third one is when you learn to earn. Today I wanted to focus on the second aspect, which is learning to sell. Because very often when we start as investors, we know how to buy. Buying is the easy thing, but we don't know exactly how to sell. And very often when we sell, we are like Smeagol in the Lord of the Rings. We say something like, "Oh, precious, my dear precious, I can bear to live you, precious." And we treat the stocks that we buy as precious things that we cannot, absolutely cannot do away with. How can we approach selling decisions in our investments? Well, today I wanted to share with you firstly why it's so difficult, and then after that 4 principles that will help you to think better about selling. So why is it so difficult? There are 2 reasons. The first one is because of our natural aversion to losses. A bird in hand is worth 2 more in the bush. Very often when we see a stock losing, we tell ourselves that at least I know that I'm losing, rather than taking on the loss permanently. We tell ourselves this is just a paper loss. Well, it's not just a paper loss. If you look at Reframe Shaw's book, The Art of Execution, he writes about how we end up losing more and more the longer we hold without doing anything. So from his data, he actually studied 18,000 trades, and he found that when you had first lost 20%, you needed a 25% gain to break even, 33%, 50% gain to break even. And his recommendation is that between the 20 to 33% mark, it is when you need to do something rather than just thinking about the best scenario. And of course, the best scenario is that the stock will rise again without you doing anything. But we all know that hoping doesn't change anything. Instead, it is the material adjustment and the adaptation that will change things. And then let's look at the second bias. The second bias is our confirmation bias. Well, if you look at our confirmation bias, what is it, right? We tend to search for the things that confirm our thesis rather than disconfirm it. For example, when I first bought Raffles Medical and it fell more than 40%, I went on esoteric forums and stock junctions to look at what people were saying, and mostly they were saying the same thing, like this stock is going to rise because of so and so reason. The management was saying the same thing, but 3 years later it was still at a 40% loss and I had done nothing. The thing about paper losses is that it will become permanent if you choose not to do anything about it. Sitting there waiting and hoping for the best is not going to help. I say that again, it is not going to help if you sit and do nothing when there is a 20 to 33% drop in the share price. Well, then let's look at how do you sell. But before we look at that, we have to look at how do you buy, right? So in Hagstrom's book, the Warren Buffett Money Mind, he looks at how Warren Buffett studies businesses. Well, he found 4 tenets or 4 pillars: the management, the financial tenet, the business tenet, and then the market tenet. And over the next few minutes, just wanted to share the 4 tenets that are important to Warren Buffett. Firstly, it's the business tenet. So when we look at the business, the first question to ask yourself is, do I understand this business? Do you understand it? Well, if it's an industry that you don't understand, best thing is don't buy it. If it's an industry that is prone to huge changes, then unless you understand the industry very well, don't buy it. And then the last thing is to think about whether it has favorable long-term prospects. When Warren Buffett buys stocks like Coca-Cola, Apple, he buys them for the franchise. They know that for the next 10 to 20 years, they'll probably be still selling Coke or Apple iPhones. There's no real change to the prospects of this being the center of the person's life. People still drink Coke, people will still use an iPhone, but if you look at something more esoteric, say for example, the airline industry. Well, people still fly even in COVID, but you never knew how COVID would affect. And if you don't understand the industry, then there's no point buying it. Understand the business, understand the industry, and understand the long-term prospects for your long-term outperformance. Then the second thing is to think of the management. Do they think like owners? How do they allocate capital? In William Thorndike's great book, The Outsiders, he found that the CEOs who were best were those who were great at capital allocation. It is how they allocate capital whenever they have access. Do they return it to the shareholders, or do they choose to invest it in the business? And over time, this return on equity and capital invested with them is what determines the long-term performance or outperformance in the stock market. So you see, the financial tenets that Warren Buffett looks at is the return on the invested capital, then the free cash flow, and then the margin of safety. Well, these are probably things that you also know of, but the most important thing is this aspect of its return on invested capital. This measure is far more important than the usual earnings per share that most investors look at, because earnings per share can be massaged or it can be managed. But if you look at the return on the invested capital, that's not something that can be massaged that easily. Well, then when you look at the last tenet, the market, that's only one thing. Is it below the intrinsic value of the stock? Is it below the intrinsic value of the stock? Well, in looking at these four tenets, now you have a better idea of how you buy. And with those 4 points, you can start thinking about how you sell. If any of these tenets fail, that's when you should start re-looking at the stocks that you are buying. And as Warren Buffett once said, as far as I'm concerned, the stock market doesn't exist. It is only there to see if someone does something foolish. In Warren Buffett's eyes, he loved the intelligent investor and the analogy of Mr. Market. Every day Mr. Market is there to bring you a stock price, right? Some days he might be depressed and he might bring you a very low stock price. Some days he might be maniac and he might bring you a high stock price. It is your responsibility to decide if Mr. Market is being crazy that day, or whether there's a way for you to take advantage of what Mr. Market is doing. So it is your choice. Mr. Market can never force you to do anything. Only you can make that decision and that choice, and you have the freedom to do so. So stop looking at the stock market, but start looking at the business that you are buying. The first principle in thinking about selling is that doing nothing is not an option. Doing nothing is not an option. As you can see from this, when you lose, your possibility of a permanent loss is higher when you do not do anything. Let me say this again. Your possibility of a permanent loss happens when you do not do anything. Just now we showed this table, but what you might not know is that in Lee Freeman Shaw's book, he studied 45 of the greatest managers, and he found that out of this, 49% of their trades did not make them any money. That meant that they were wrong most of the time. And out of the 30 most famous managers that were managing funds on behalf of him, they were only right 1/3 of the time. It was what they did after the trade rather than what they did before that determined their ultimate success. In much the same way, it is what you do when you are facing a paper loss that determines your long-term success. Doing nothing, sitting on your hands, is not an option. You can either choose to add or you can choose to cut your losses, but doing nothing should not even be an option. If the stock is really as good as you say, and analyzing it against the 4 tenets that we talked about just now, you should be adding to it, not waiting and doing nothing. But if the tenets are perhaps not fitting, then that's when you should decide to cut your losses. Well, as Warren Buffett said, an investor needs to do very few things right as long as he or she avoids big mistakes. Your role in investing is not to win big, it is to avoid losses. Warren Buffett's 2 rules. Rule number 1, never lose. Rule number 2, never forget rule number 1. As an investor, very often we think about the multi-baggers that we can make, but we don't think about avoiding losses. The way that we can avoid losses is to do something when you are facing a paper loss. It is not to sit on your hands and to do nothing. It is to stick within your circle of competency, knowing and defining that circle very well, rather than going out of that circle and studying esoteric businesses that you might have no idea about. Secondly, the principle to think about is that of the mistake. Very often I see investors who are unwilling to cut their losses because they associate the mistake with them. You become your mistake. Rather than thinking of a mistake as a behavior, you think of your mistake as you. You associate the behavior with the being. And that's why you associate your self-worth with the losses that you have made in your investing journey. That is something common, but it's something that you need to detach yourself with for your long-term success as an investor. Because as investors, none of us are perfect. You are going to make mistakes. But if you hold on to your losses, telling yourself that I am my loss or I am my mistake, then it no longer becomes a rational investment decision. It becomes an emotional decision that is tied to your self-worth. Your mistake in investing becomes you. But that's not true. You are more than your investment decision. You are more than your mistake. And it is only when you are willing to look past your mistake and to learn from that you begin to outperform. So there are certain ways. You can reframe your loss as a lesson. In Guy Winch's book, Emotional First Aid, he looks at these 6 questions that you can use in order to look at learning from your failures. So these 6 questions are: what should I do differently next time? What opportunities might my failure present? In what ways might my failure make me stronger? What ways is my failure a success? How much more will success mean to me now that I've experienced failure? And can I identify ways I derive meaning and satisfaction as I pursue this goal? I'll invite you to take out paper and pen and to just write about some of these answers to these questions. This way you start reframing your loss as a lesson rather than your loss as a point for you to weep more. Well, now the third principle about when you should sell is when there are better rates of return elsewhere. Very often as investors, we might not look for the big upside potential. We have too many ideas and we cap our upside. We look for the 10 to 30% gain rather than the multi-baggers. We refuse to let our winners go even higher, but instead start realizing our gains the moment we get them. And here I want to give you an example of that, of a capped upside. A stock that I bought, Sing Holdings. Well, as you can see from this brief chart, over the 10 years that it's been listed, it's not gone very far. It's not gone multi-baggers. But I bought it because I thought that I could have something secure. But that's not great, is it? When you look at a stock like that, sure, you might gain 5% every year from its dividends, but in terms of growing the upside, that's not great. So rather than investing in your 60th best idea, why not invest in your best idea? So look at it this way, right? Now you're winning. What do you do? Well, there are a few things. Write your winners. So in Lee Freeman Shaw's book, he found that the best investors were those that were able to write their winners. They savored their winnings by slowly trimming down their holdings whenever it grew. This helped them to savor their winnings rather than being too anxious and not realizing their winnings at all if there was a huge market downturn. This also helps you to be invested for the long run rather than thinking about the short-term gains. Rather than realizing your entire portfolio and selling it when you get a 20% gain, savor it like a connoisseur, like a wine connoisseur. Nibble a bit, gain a little bit, and over time you will realize that that will yield you greatest advantage. Well, the last one is to think of this principle. Here you see a face wash bottle, and as you know, I am a very thrifty person. And when I was trying to save more money to invest, I ended up cutting this bottle into two just so that I could scrape off the face wash liquid and use it a few more times. You might laugh at this, but today I want to ask you a question. Are you living to invest? Are you living to invest? When you invest, you are putting aside a lot of money. It can be tens of thousands of dollars. And very often you might be tempted to be unkind to yourself when you make a mistake, when you sell too early, or when you sell too late. But today, realize that it is not about living to invest. It is actually about investing to live. Invest to live. When you invest, you are looking to secure a better future and a better present for yourself. You are delaying gratification, but you don't have to hurt yourself in the process of doing that. When you look at me, I was scraping off face wash bottles just so that I could have that few cents to invest a bit more. Well, sure, in the short run, that might have seemed nice, but in the long run, was I really enjoying myself? And the question is no. So today, when you look at investing, don't just think of it as something where you are torturing yourself for long-term financial gain. Rather, enjoy the process. When you make a mistake, learn from it. And most importantly, invest to live. Don't live to invest. Thank you.